The Sure Investing Podcast, investments and strategies to help you safely compound your wealth over the long run. The Sure Investing Podcast is hosted by Nick McCullum and supported by Sure Dividend, an investment newsletter provider aimed at helping people invest better through low-cost, long-term positions in individual securities. All opinions expressed by Nick and podcast guests are solely their own opinions and do not necessarily reflect the opinions of Sure Dividend. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. For more information about Sure Dividend and the research our firm provides, go to www.suredividend.com/research. Today's conversation is with Eddie Lorin, the founder of Strategic Realty Holdings and Impact Housing REIT and the co-founder of the HAPI Foundation. During his 30-year career, Eddie has been responsible for the acquisition of more than $3.7 billion in office, industrial, and apartment community assets nationwide. Since 2001, he has successfully purchased and transformed more than $3 billion worth of multifamily real estate, amounting to more than 180 thriving communities with approximately 40,000 apartment units. In this conversation, we talk about the merits of socially responsible investing, the workforce housing crisis in the United States, and how Impact Housing REIT is different from the major real estate players. Please enjoy this conversation with Eddie Lorin. What I had in mind for this conversation was to give our listeners a broad overview of, what are the benefits of REIT investing, why Impact Housing REIT is different than your typical real estate investment trust. And I thought a cool way to do that would be for us to kind of turn back the clock to the beginning and hear about how you became interested in real estate investing at the start of your career.
Well, when I was at UCLA, I was trying to figure out what should I do with my life. And I thought about the basics: food, clothing, and shelter. I tried food, didn't really click with me, and clothing, selling clothing, I wasn't too bad at it, but it wasn't really my shtick. And then I got into shelter. So I went into office buildings, apartments, ultimately, because I found that apartments are easier and less institutional in terms of moving the needle. Institutional real estate, retail, office, industrial, these are all longer term leases, and you're not able to be as nimble or make as much of a difference. And it's really hard without institutional capital to be in that business. So what I chose to do was to go after B and C assets, a cash flow driven business. And I've always underwritten things for cash flow and not for upside, but the upside's always great because it comes from cash flow.
That's interesting. So your first real estate investments, were they from your own capital, or did you get a job at a real estate company to kind of learn the business before you started it on your own?
Well, I worked for a company. We bought 25,000 apartment units in the 2000s. So I have extensive experience in 200 deals that I bought across the country, and value add and rehab. So I saw it all. I worked for someone else for sure. So that was a really important way to cut my teeth, so to speak.
Yeah, definitely. I find that's a common trend among the people we speak to on the podcast, is they kind of learn the trade with someone else before breaking out on their own. What would you say were the biggest learning curves when you first got involved in purchasing and managing real estate?
You have to provide value. It's all about value. Value to your residents, value to your shareholders or your investors, and value to your managers. They have to have a nice, great place to create a sense of community. It's all about a sense of community, because if people get value, they stay, they pay, and they refer their friends.
Tell us about the transition from that part of your career into starting up Strategic Realty Holdings and eventually Impact Housing REIT.
Yeah, in 2008, everything blew up, and my predecessor kind of said goodbye because we didn't see eye to eye on how we could work through these assets. He didn't really care about the end game, which was the resident, and I've always been very keen on who pays our rent, the resident. So he, kind of neglected the properties, et cetera. So I developed a keen interest in really taking care of the value add and the opportunity for residents to get a clean, safe, affordable place to live. So we started Strategic Realty and bought about 15,000 units and value add across the country. And it was really a great opportunity to buy distress and take some of the unbelievable opportunities and transform them into thriving communities. And as a result, I realized that all these years I was an impact investor. And what's an impact investor? An investor who wants to invest with a purpose. So you do well by doing good. So I invested in properties and realized this new burgeoning industry called impact investing is really all I've done for years. So the Jobs Act was passed, which allows non-accredited investors to come in as well as accredited investors in a crowdfunding space. So the opportunity presented itself to form a crowdfunded REIT. And so that's what I've done. Went through the SEC, and now we're going through FINRA, and we have a viable security that can provide value to everyone in the form of a somewhat distressed investment platform to buy value add apartments.
So this was started in, it sounds like right around 2008 or shortly thereafter. So there's obviously lots of opportunity at that point in the cycle, but what were the big challenges of starting a real estate investment trust or realty holdings at that point in the real estate cycle?
Well, the capital was hard to find. Everybody was scared to death in 08, 09. So you had to find investors who were willing to come in, and it was very expensive capital because, of course, everybody wanted blood and they were afraid. So even though we bought things well, it was a challenge to get the capital to come in. And ultimately, things got better and got easier. I formed Impact Housing just a year ago, by the way, the REIT, because the Jobs Act didn't get passed until 2012, and it got refined in 2016. So this is a new venture as a result of the opportunities in crowdfunding.
So your work since 2008 has been with Strategic Realty Holdings mostly, and then more recently with Impact Housing REIT.
That's correct.
It sounds like your work with both companies is focused on purchasing and revitalizing old, neglected, or mismanaged properties. What would you say are the major pros? And I'm more curious, I guess, about the major cons to taking that approach to purchasing investment properties. So how do you think about that?
Well, you're buying older product. The con is you're dealing with properties that aren't shiny and new. So people want more of a return. They turn their nose at it more. And it's not shiny and new with 10-foot ceilings. So, there's a trade-off, but you're also paying 40, 50% of replacement cost. So there's value there. And the basic value proposition is if rents are $3,000 on, let's say, brand new product, and let's say that's $500,000 a unit in Los Angeles, and you're able to buy for $2,000 a unit. Sorry, for $200 a unit. So that's a 2/5, right? So you've got that value. The rent of 2/5, usually those rents are around $1,300-$1,400. They're not 2/5, so to speak. 2/5 would be $1,200. So I think you're getting higher rent on the lower end product because people need affordable housing. So that's the real value proposition. Providing lower end product that people can afford. There's only one way to build, and that's luxury. You can't build old product. And the difference between the cost to build new product and to buy existing and rehab is so huge that that's the true value, and that's how you get cash flow. It's hard to get cash flow on shiny new product. It's really not a cash flow proposition. So that's the difference. What kind of investor are you? Does that make sense?
So it sounds like, yeah, the discount you get on the purchase price is not nearly as large as the discount you get on the rents that you're going to capture, which means you're getting a better value on buying older properties. Am I thinking about that right?
Yes, but it's not sexy because the institutional smart money, so to speak, they all want brochure quality stuff that's going to look great on their investor presentations, but the yield's not there. The yield goes to what's basic housing that everybody needs.
It sounds like this aversion to institutional money and the institutional mindset may be a reason to why you decided to do a crowdfunded REIT instead of going to institutional investors and maybe to the public markets. Is that correct?
You got that right.
Buying used real estate, the way I think about it is there's probably like the average return is higher, but the distribution around those returns is greater. So you're going to have, if you're not careful, it sounds like you could probably buy a property that's a complete dud and can really be a drag on the returns of your overall property portfolio. So with that in mind, I'm curious about your due diligence process for real estate investing. What does that look like?
Well, I get Fannie Freddie debt, so I have an institutional due diligence process. We first start with a walk of every unit. We have contractors go through every system. We do title searches. We get a survey. We get a zoning report, environmental report. everything, soup to nuts, complete package. Due diligence is critical, or you'll never close on a government sponsored loan.
And what are some serious red flags that make you immediately disclude a property from your deal flow?
I just talked about one today. Unfortunately, the yield was so tremendous in a suburb of Dallas. The area is never going to be anything more than it is, at least in the next 20 years. And we have a 5 to 10 year investment horizon. So you want to buy trending neighborhoods, and neighborhoods do transition, but you want to make sure that's going to transition in your hold period, not transition on a hope and a prayer in 20 years. That's the issue.
And when you think about the transition of neighborhoods from maybe substandard to average to luxury eventually, what are the factors that you would incorporate into your projections? Are they mostly qualitative, or do you look at quantitative numbers as well?
Well, it's quantitative is crime reports and whether it's trending in the wrong direction. That's the quantitative. Qualitative is, can you make people feel safe, because that's how they're going to stay. They have to feel safe. You have to be safe. And not to say that areas don't transform, and we're not necessarily looking for complete gentrification. We're looking for stabilization.
Having a neighborhood that's not going to improve is a red flag for you. Are there any other major red flags that you watch out for when you're doing your due diligence?
Well, anything that comes up in the due diligence, like one property we're buying, we have a major problem with the electric panels. It's old, and there's no way to fix them other than a huge number. And we've gone to the seller and said, we need help with this, or we're not going to be able to buy it. It's just, this is not something that's going to create value. It's an infrastructure issue. And, some of the physical needs on a property, you don't get the value, versus when you go in and renovate the units, you can get the value out of that, or you can create common areas that people can hang out and thrive in. You'll get value for that. It's state-of-the-art fitness center, resort style pool, all those things are accretive and value add. The challenge is when you're buying something and you're just replacing the plumbing. Well, you don't really get a value add out of that per se. You get some environmental returns and you get some cost savings, but it's, nothing's easy. Everything is, everybody's asked you a question. It depends. It depends on a lot of things. The models are sensitive. You got to analyze whether or not you can get the pop, whether your savings are enough. Are there other alternative funds that you can provide from government or in utilities to incentivize you to help you create that what we say environmental bottom line? So impact investing for us, we want a triple bottom line: a financial return, of course, an environmental return. We want to save electricity or water or utilities. And the third return is a social return. We want to give people a clean, safe, affordable place to live, and we want to make it affordable. So we don't rent to people who make more than 80% of the area median income, and that's how we can provide a solution to the affordable housing and challenges of workforce housing in this country. Again, we're only building a product. It's getting more expensive, and the older stock is starting to atrophy. And there's probably 11 million units that could be rehabbed and made nice so that people can have that clean, safe housing that is really going to treat them with the dignity they deserve.
Now, the workforce housing crisis is an interesting thing to think about because it's far worse in some regions of the country than it is in others. So with that in mind, I'm curious how you think about geographic diversification and how do you target new markets to enter into in terms of searching for potential new investments?
Well, there's never a good time to do a bad deal or a bad time to do a good deal. I only go into markets that I've been before, and the good news is I've been in 48 states. So I have relationships across the country. I have experience. And so as a result, I feel confident going into most markets because I've been there before. So, it's a little different for someone who's new. I have the benefit of all this experience. And as a result, I look for where I can see something that other people just don't, or they'll turn their noses at. And I'll do some deals I'll make a judgment call that I can transform something that most people say, what does he see? And I've done it so many times. It's like a franchise. We go in, we start with the sign. We want someone to see the sign and say, I only wish I could afford to live there. And lo and behold, once they get inside, they can afford to live there. A beautiful paint job, resort style pool, as we mentioned, state of the art fitness center, outdoor social areas, beautiful clubhouse, nice social areas to relax, pet parks, interiors that are renovated tastefully but not over improved. And the entire package creates a sense of community that people feel like they want to be there and they're proud of their home and they can afford it. And that's a really simple formula. It's not sexy, but it's really wonderful to be able to provide value. We also have health and wellness programming in our nonprofit called HAPI, Healthy Apartment Property Initiative. And we provide community gardens, nutritional counseling, health screening. All these things say we care about our residents and we want you to feel like this is your home.
That's a nice segue because I wanted to talk about the HAPI Foundation for a little bit on this call, or maybe quite a bit. So tell us about, I guess, what inspired you to co-found HAPI Foundation, and what I'm particularly interested, I guess, also in how the foundation is funded and what the foundation does with the money that it receives. So that's like 5 questions, and it was pretty broad, but I'll let you take the floor and run with it.
We founded it HAPI because my mother actually, when I was young, taught diet classes, and it was always in a YMCA or some restaurant, and it was always a challenge to get people to come out of their homes. The good news is we have 200-300 unit apartment communities, and we have clubhouses, and we have a captive audience right where people live. So the concept of being able to provide counseling and programming right where people live was the most compelling reason to start. Again, it's a challenge to get people their work, sometimes 2 jobs. They're not going to want to schlep over to another appointment or another class. So that was the impetus. We also my wife is passionate about gardening. And when you see the faces of these kids that are at risk grow their first vegetable and eat it, it's heartwarming and it's amazing. So as a result, we found that when you get to the kids in after school programming, you can teach them about health and wellness, and then the adults will follow. Unfortunately, it's not the opposite. You have to go to the kids first, and then the adults will come. You try to go to the adults first, and it's more of a challenge. So that was the reason we started. We have private funding, and we also funded ourselves from the properties to create the programming that helps bring in that sense of community. It's really just about giving people the respect that we care about them and we care about their health more than just caring about them as individuals. And so that's kind of the impetus on why we started HAPI, and it's really a wonderful opportunity for us to give back.
Yeah, that certainly sounds like a very important and admirable venture. Congratulations on doing that. That's really cool. I want to turn back and talk a little bit more about Impact Housing REIT. So right now it is privately held, which for a lot of people makes it somewhat opaque and a bit of an enigma, because like for me personally, I don't have any experience with privately held investments, and I'm sure there's quite a few of our readers who are in the same boat. So what are the steps that I guess an investor must take before purchasing units of the trust?
Well, it's 2 or 3 clicks on the website, impacthousing.com. It's very simple. The bigger question you're asking is about liquidity. And there are ways to sell shares on the secondary market that exist. So there is a market in case people want to sell, but you shouldn't be buying REIT stock unless you're going for the long haul. That's why it's best for your IRA investment to make REIT investments, because real estate is meant to be a long-term hold and illiquid. So if you're investing in REITs with money that you need to live on, it's probably the wrong investment. That's the best advice I could give. But if you're looking for long-term appreciation and cash flow and you want it tax sheltered in your IRA, it's an opportune way. And the difference between a crowdfunded REIT and the publicly held REIT is about 10% in costs. We're going direct to the consumer, and Wall Street gets in the middle with a lot of costs and fees. Most people wouldn't have the opportunity to get access directly to people like us without this new law of crowdfunding.
Now, I think I probably know the answer to this, but I'm curious to ask anyway. Do you ever have plans to take Impact Housing to the public markets?
Sure, it could possibly be our exit, or we could just exit on our 5 to 7 year plan and sell every asset and make a great return for people. So you never say no. It's never a good time to do a bad deal or a bad time to do a good deal, but I will not put my shareholders and myself at risk if it's the wrong decision, in my opinion.
One of the things that a lot of real estate investors and REIT investors in particular are thinking about right now is interest rates. So the Federal Reserve has hiked interest rates numerous times over the past several years, and they've communicated the intent to continue hiking into the future. So how do you think REITs will perform in a rising interest rate environment? And so both fundamentally as a business, and then also how much of this do you think Impact Housing is potentially insulated from because of the fact that you're privately held?
Well, I don't know whether private or publicly held matters. I think interest rates are key to your returns. But look, today the 10-year is down. It's 281. It seems to be hovering for the last few years. Even with all these interest rate hikes, it's still not over 3. I don't see interest rates going crazy, potentially, but we buy and we fix long term. So Fannie and Freddie loans, which we're having a fixed rate, so we'll be in the mid 4s fixed for 5 to 7 years. So, we don't take interest rate risk in the REIT. So as a result, fixed rate debt is really important. And the good news is that because we do health and wellness and we do affordable housing, we get the best, most favorable pricing from the agencies, Fannie and Freddie, as a result of doing these deals. And that's because they're cash flow driven, and we're able to spit off a lot of cash flow as a result, because we fix those rates. We're not taking that interest rate risk.
So socially responsible investing sounds like it's almost a competitive advantage in a sense because it reduces your cost of capital. Am I interpreting that correctly?
Yeah, and it helps you save some expenses too. People always think about, oh, you're raising rents. That's the only way to make money in real estate. No, you can also lower expenses, the same bottom line. Well, this property we're buying, a high rise in Maryland, and funny enough, there's a high rise of 12 stories, and then there are 48 townhomes that are owned individually. Believe it or not, when the owner, 2 owners ago, they built these townhouses, sold them off individually with one water main going into the property. So the high rise, it's owned by an institutional investor, is guessing on what to bill back to those 48 individual townhomes. So as a result, they're not paying their fair share, and there's some leakage going on. So we're going to fix the leaking, save the costs, and more important, we're going to bill back those 48 townhomes exactly what they're supposed to be paying instead of guessing. And so that's going to save expenses. We're also, the common area hallways have incandescent bulbs. Believe it or not, you can save tremendous amount of money and the carbon footprint by taking LED lights and replacing them. And they not only last longer, but they actually use much less electricity. So you can lower expenses by making a difference environmentally, as well as you can, of course, rents raise as well. So bottom line is, what's your net income at the end of the day?
Socially responsible investing is really core to all you guys do. So I assume that's probably going to be the biggest answer to my next question. But I wanted to ask you, how do you think about how Impact Housing REIT is different from the offerings of your competitors like Blackstone or Turner or the other big names in real estate? So what differentiates you guys for people who are prospective investors?
Well, you mentioned Turner. They bought from me, so that explains everything. I was the one who purchased and renovated a property and really did the value add and the impact. And then there's Blackstone. They're still an institutional investor. We're scrappy guys. We go in and we see what others don't. A lot of these institutional investors turn their noses at a lot of things. Now, I mentioned that we don't do every deal, but there's many deals that Blackstone or the bigger guys won't do because they'll turn their nose at it. So it's just a different mentality, and it's a different experience level. And look, I'm a lot smaller than they are, so I can be more nimble and I can make more executive decisions. Now, Now, Blackstone has a history of, just going for a certain yield, and they're happy with it. I had a deal with Blackstone. They were our partners, and they've actually made us sell too early. And I think we left a lot of money on the table because it fit their big picture. I don't have a big picture. I have a small picture. Every deal stands on its own, and it has to make sense. And just like children, these are, every property has its own DNA and its own time frame. And some of the bigger guys tend to loop things in on a fund mentality rather than treat each deal with its individual character and what the end result and the best business plan is for that particular asset. So it's just a different way of looking at it. Not to say it's not. Look, they're publicly traded, and they're a great investment. They're the biggest owner in the world. You can't take anything away from Blackstone. It's just different. It depends on what your tolerance of, your risk tolerance is.
So one of the big differences is size. I'm curious as to whether you think growing in size is going to make it more difficult for you to implement your strategy of acquiring apartment real estate on a value add basis. Is it going to be harder to do as you grow?
No. The problem is that there's such a fundamental shortage of housing in this country. I think any apartment investing is safe, honestly. So whoever you feel comfortable with investing, I don't think you're going to go wrong. There's just so much now. I think on the luxury, on the high end, there's some risks. So some of the like Avalon Bays and stuff like that, when they're razor thin margins because they're buying beautiful product, I think that's more risky. But I think, they still have a lot of product that they've bought right over the years, and they, it's fine. All sectors will work. I just think the real value left is in affordable and workforce housing because there's such a shortage, and everybody needs a clean, safe home. And like I said, there's 11 million units that need to be rehabbed across the country, and we're going to do our share.
Where are you seeing opportunity in today's real estate market? Are there any cities or states or, I guess, particular geographies that are standing out to you, or asset classes for that matter?
Well, I'm just an apartment guy. So to me, I think affordable housing will always stay full. Workforce housing, if you can do an incremental value add, people will pay for a little nicer community. Let's say A rents are $3,000 and rents are $1,200, and you put in some money, you can get $1,350, still affordable, reasonable by anybody's standards, but you can still get that incremental value on your investment, and that's what we look for.
I've read quite a bit about how recent changes to our tax code will impact investors in publicly traded REITs. How will investors in Impact Housing REIT, which is private, how will they benefit from recent changes to the tax code, the Tax Cut and Jobs Act?
Well, the Jobs Act, we already talked about. It allows anyone and everyone, regardless of income level or wealth, to invest in institutional type real estate investments like ours, because non-accrediteds can do what the accredited investors could do. So that's Jobs Act. The tax code favors real estate investment. There's accelerated depreciation opportunities, and there's 20% benefit of pass-throughs to entities that own real estate, and that's very favorable. This was our president, love him or hate him, he is a real estate guy, and this tax code benefits real estate investment, period.
So you think this is a big tailwind for your business and for your investors?
Yes, I don't think it's the right thing politically for the society. We have such a shortage of housing. We need to help. I mean, they're cutting the budgets to help the working poor versus the opposite, which needs to happen. So, there's a two-edged sword, just like everything in life.
I want to talk a bit about quantifying returns. So on your website, I read that the internal rate of return that Strategic Realty has realized on 40 properties that you've purchased, rehabbed, and sold over the past 9 years has been about 25% annualized. So that's far higher than what most people can find in the public markets. I'm curious about what are the key drivers of returns for you as an operator and for investors in your fund?
Well, we target high single-digit cash and cash returns after we stabilize. So half of that return would come from cash flow, and the other half would come from some appreciation. So, I'm not allowed per the SEC, since this is a non-accredited offering, what they call an A plus. I'm not allowed to project returns. All I can say is that our track record speaks for itself. Now, those returns were maybe a little skewed because the markets were a little different, but there are still great opportunities to make mid to high single digit cash and cash returns, and close to 20 IRR gross is how we target. We can't guarantee. Future returns are not predicted by past. It's like the drug commercials. You got to give all these disclaimers. I'm not allowed to project what we can make, but we always target the same returns on any investment we would do. So we expect the same results as we have delivered in the past.
I guess I want to dig in and ask a more specific question about returns. What component of returns that are delivered to real estate investors would you say comes from the ability to leverage with low interest rate secured debt against the properties?
Well, I think, if you can buy a cap rate that is higher than your financing, that's positive leverage. So let's say your cap rate's a 6. If you can buy one and you're financing at 4, significant amount of that positive leverage comes in your current cash and cash return. And that's quarterly dividend that really adds to your bottom line investment. If treasuries are, like we said, 10-year treasuries are 281 today, and you're able to get a current return of 7-8%, that's a huge premium, let alone the appreciation. That's why real estate is worth the perceived risk, even though I don't think there's a lot of risk because there's such a shortage of housing. And current return is how you should measure your willingness to go and do something that's not, let's say, a 10-year bond.
What are your thoughts on buying properties where the cap rate is lower than your cost of financing?
Well, it depends. What's your stabilized cap rate? You could have someone who's mismanaged something. You could have expenses at $5,000-6,000 a unit when they're supposed to be $4,000 a unit. So all of a sudden you may be buying a 3 cap, but it's really a 5.5 cap once you stabilize. So it depends. That's, the answer is always going to be it depends.
But it's definitely related to your ability as an owner-operator to improve the financial characteristics of the property, right?
Sure. And we look at tons of deals and we pass on most. It's just the way it goes.
Interesting. I want to ask a few questions that are kind of in, I guess, the fun category. So what is the most memorable day of your career in real estate?
In 2006, we closed 20 deals, 5,000 units at once. That was amazing. We were a coordinated, well-oiled machine, and there's exciting times in the business. It's fun. It's a fun business. And the other thing I would say is my favorite time is once we close on a property, setting the business plan for how we're going to transform it in terms of what are we going to renovate, what color we're going to paint it, where we're going to put all the amenities. That's the fun part. That's the exciting part, because we truly can transform communities, and it's great.
Another question from the fun category is, are there any people who have acted as a mentor or an advisor to you that you would say have had an outsized effect or an outsized impact on your success in the world of real estate?
Oh, I've had 30. You learn from everybody every day. And there have been some great mentors I've had and that I've gotten tremendous amount from. And then there's snippets I've gotten along the way from different people. But people are everything. Relationships are everything. If you treat people with respect and ask for their advice rather than try to sell someone, they'll be happy to help you. And we all have to help one another. That's why we're giving back. It's a really important thing, mentors.
I agree 100%. If you could go back to the beginning of your career in real estate, say you had a time machine and it could take you back to 2001 or so, what piece of advice or pieces of advice would you give to a younger Eddie Lorin?
Mm-hmm. Don't go astray. Stay with what you're good at. Stay with whatever makes you happy and however you can provide value where others can't. I jumped around, like I mentioned earlier, from office, retail, industrial. If you're lucky enough to find your right niche, just stay put. And just over time, success comes from your experience and your staying power and your patience and your persistence and your belief in changing the world and making a difference. It's so important to really believe strongly and have the patience and purpose to what you're doing. And I was too excited and too hell-bent on being successful so fast. And you just got to take your time and smell the roses and enjoy the process. And it's so much easier said than done. I really do look back and say I should have calmly attacked rather than aggressively attacked, because in the end, it's the life in your years, not the years in your life.
That's an excellent sentiment. My last question is about learning. So you've clearly developed a lot of expertise about real estate investing and investing in general. I would say a lot of the things we've talked about are generalizable to other asset classes. So how do you think about learning more about real estate and learning more, I guess, about other things in general?
Well, it depends if you're talking someone young or someone older. I mean, to learn, you can always read if you're older and you're not going to go out and start again. But if I'm young, starting out in this business, I go and become a property manager. Then I become a lender. And those two are the key components of the business. Because if you don't know how to collect rent, turn a unit, renovate a unit, deal with delinquency, deal with evictions, deal with unhappy residents, security issues, all the things that go into the essence of the cash flow, and they're real people paying real rents. I think it's so important to understand what it's like to be a property manager. And another thing is, we can't do anything without leverage unless you're blessed to have hundreds of millions of dollars in cash and you don't need to leverage real estate. Pretty unlikely. Most people always get a loan. To understand what it's like to be a lender is the other key component, because nothing happens without that lender. And they have a lot of power and they have a lot of control. And it's a really important perspective to have. So property management, then lending, then ownership is how I would start in this business.
Awesome. Well, thanks so much for your time today, Eddie. I learned a lot, and I'm sure most of our listeners did too. Looking forward to staying in touch and learning more about what you guys do.
All the best. ImpactHousing.com. Come join us.
Thanks so much for listening to today's episode, everyone. I invite you to check out our website at sureinvesting.co, see our premium investment research at suredividend.com, and also check us out on YouTube, where we publish videos under the name Sure Dividend. See you next time.